Black Knight released their appreciation data for January, showing that home values rose 0.2% in the month and remained up 5.6% on a year-over-year basis. CoreLogic reported that home prices fell 0.1% in January and are now up 5.8% year-over-year, which is an increase from 5.5% in the previous report. We're seeing a similar pattern to last year where appreciation went negative in December and January, but to a lesser degree this year, which is why appreciation is rising year over year. Now, CoreLogic forecasts that home prices will be flat in February and will rise by 2.6% over the next 12 months. CoreLogic Q4 equity report showed equity rose 8.6% year over year, which is $1.2 trillion through appreciation and amortization, which is significant. Many can likely benefit from a refinance to remove their MI right now. The total number of homes with negative equity fell 1.1% from Q3 to Q4 and is down 15% year over year. There's 1.2 million homes, or 2.1% of mortgage properties they have negative equity, which translates to 1.2% of all properties, which is very low. Inventory has increased slightly over the past few months, which is needed to keep up with the increase in demand. It's great that home prices are staying strong. Now we just need more options for buyers. Now, as for mortgages and inflation, the February ADP employment report showed that there were 140,000 jobs created during the month, which was a little weaker than the 150,000 expected. The January report was revised slightly higher from 107,000 to 111,000. There's been a huge disconnect between the ADP and the BLS numbers, primarily because the ADP only shows private payroll numbers and real data. As for the BLS report, they use a ton of numbers and estimates and modeling. We will get the BLS report tomorrow, and it could be a market mover. If the BLS report misses, we could see mortgage rates continue their move lower. We really need that. Now, the MBA released their mortgage application data last week, showing that their purchases rose 11% last week and are now down only 8% year over year. As of today, interest rates are just under 7% on average and are about 0.25% higher than last year. Fannie Mae expects mortgage rates to dip below 6% by the year end. This will create more demand, but also more refinance opportunity. This is why I believe focusing on buying now, knowing that you can refinance in the next 8 to 12 months. Waiting for rates to drop will cost more in the long run with higher prices.